Hello, and today we are discussing Henry Schein Incorporated, ticker HSIC. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. We have a market cap of $9.8 billion, enterprise value of $10.7 billion, so you can see about $1 billion in net debt on this business, only about 10% of the overall enterprise value, so not that much. Healthcare providers and services. It's an interesting industry, so they provide healthcare products and services to dental practitioners and laboratories, physicians, ambulatory surgery centers, government, institutional healthcare, other clinics worldwide. So healthcare doesn't sound like they're in the real estate side, but they're actually the healthcare product and services portion. So they have dental products, infection control products, handpieces, preventatives, impression materials, composites. So these sounds like kind of one-use products, abrasives. And then here's kind of some like infrastructure, dental chairs, delivery units, lights. So they're providing tools and resources to this healthcare industry, especially dentists. Technology and value add includes software, technology, practice management software systems. This sounds like a really good business from the description. X-ray supplies. What's good about this is you have some one-time use products. You have some constant need to rebuy some of these things. Overall, kind of a really interesting industry. Whenever you have those repeat purchases, you could have some pricing power. You could have some customer lock-in, and that can be a really nice setup. You see a beta 0.79. That's another good sign because it means it's 21% less volatile as a stock than the S&P 500. The lower volatility that tends to be a sign that it's a relatively high quality business, but we can learn some more as we go down to our return on invested capital chart. So you see here, first thing that's easily noticed is you have 20 straight years of profitability. Always a very good sign when you have 20 straight years of profitability. There's not a single year where this drops below the 0% mark. So every single year they're earning a profit. Very good indicator that this is a high quality business. The second thing is you see this 10% line here. They're basically hovering around or above this 10% line in terms of return on invested capital. I really want to see that. Anytime you're getting a 10% plus return on invested capital before the use of debt and leverage, that means that you have a good chance of earning double-digit returns for shareholders. You want to see that, and you can see that since 2007 all the way to 2016, they had like 10 straight years earning 10% plus type returns. They've had a little bit more volatility since then, but otherwise they're still hovering around that 10% mark, even though they had a down year in 2020 and in 2022. Of course, 2020 was the COVID year where a lot of medical practices were shut down, especially on the dental side. So you can see that there were some potential revenue issues there, but otherwise they were still doing quite well. Everything here looks like a good business. Again, another high quality sign here. Return on invested capital average of 11%. Return on equity of 16.3%. Both of these numbers hit my hurdle for a high quality business, which is 10% plus return on invested capital, 15% plus return on equity. They're making that mark, which gives me that possibility of 10 to 15% returns without the need of a lot of leverage, without the need of a lot of dilution. I like to see that. Another thing here is you can see that those numbers are significantly above your revenue growth rates of 3%, EPS growth rates of 6%. And all that means is that you can self-fund all your growth. You're not going to need continuing dilution. You're not going to need continuing debt raises in order to grow your business. However, you can use debt maybe to boost your return on equity, which is what they're doing. So that might boost shareholder returns, but it's not necessary. You don't need to do it. It is a positive sign there. Price to sits at 0.8 is kind of an interesting, that's a pretty low number. It indicates maybe it's a relatively cheap price, but your price to equity of 18 means it could be more of the average to slightly above average price. You know, I'm looking for PEs of 15 or less, but we're only 20% above that. So you're right in the range of what could be a fair value for this business. And anytime you can get a high quality business, as this appears to be, at a fair value, it's something that you want to learn more about. It's something that can be very, very interesting. Let's go down to look at the revenue. So you can see this start at $9.5 billion, $12.6 billion. Again, you're not growing that much over the course of the decade. You've grown about $3 billion in additional revenue, 30% growth. Again, 3.5% CAGR. You know, not amazing, but it is a low number, but should be able to do that with very good returns here. Your gross profit's growing even better, almost a 50% gross profit. You can see this gross profit margin going up from 27.8% to 30%. Anytime you have that operating leverage, that can look really good. I do have some concern that your operating leverage didn't translate to the operating profit line. So you had 7.1% here, 6.9%. If you've been able to gain gross margin, you should be able to control your costs in a way that is going to give you additional operating margin, but we don't see that operating leverage hitting the bottom line. A little bit of a concern there. However, your earnings per share is growing much faster than your revenue, assets, and free cash flow. That shows that there is some operating leverage, but it could be due to buybacks. We're going to have to see if that plays in. But again, you're seeing this 247 to 391, gaining almost 50% EPS growth over the course of a decade. Very good sign there as well. Actually, a little bit better than that. it seems. So all these numbers look good. High quality business, growing at a reasonable amount. I'd like a little bit faster growth myself, but this is a very good industry, and so it looks like this is a good business in that industry as well. If you're learning something, hit that like button. Don't forget to subscribe, but we have got to check out the income statement next, learn a little bit more about this company. So cost of goods sold, again, you did see some of that gross profit margin going up here. It does look like one of their problems is the SG&A has gone up 50%. So when your revenue only goes up 30%, but your SG&A goes up 50%, it means that they're maybe having some problems with rising costs, inflation in their cost line, probably paying personnel, things along that nature that is actually causing them to grow their SG&A at a faster rate than their revenue and a faster rate than their gross profit. So their operating profit hasn't seen the sort of leverage that you'd want to see. Likewise, they're not having a lot of interest because they don't have to take on a lot of debt. So that's a good sign. There's not really a big impact there. Now, one of the big changes, of course, that you would see, let's see if it shows up here. Yeah. Look from, 2013, 2017, you see these income tax numbers in the 200 to 300 range for income tax, and yet then it dropped down significantly in 2018, 2020. Of course, you had the Tax Cuts and Jobs Act of 2017, so that's impacting that number, and it's making the net income growth look better than it otherwise would be. So that's playing a little bit of a role of why their earnings per share have grown so rapidly. Now, one thing here to take note, it looks like their EPS reached $4.45, which is quite good in 2021. And it's dropped down a little bit recently. So on that sort of metric, the stock's even cheaper, closer to something like a PE of 16 or 17. So again, it's a pretty good price here. You do see these buybacks that I like to see. You've gone from 175 million shares outstanding to 138 million shares outstanding, so 40. Maybe you've bought back 20% of the shares in a 10-year time period. That should give you about a 2% boost per year to your EPS growth rate. And if we go back to our overview, we can see some of that playing in. If you go from 3.5% to 5.5% with the 2% boost, and you have another 0.6%, which could be just due to some other leveraging effects in the business, maybe increasing the debt, something along those lines. Otherwise, though, it's really good sign when you see buybacks like this, especially on a high-quality business. Putting money back into the stock with buybacks, retiring shares is always a very positive capital allocation move, especially when a company's trading at a fair value, reasonable price, and not overvalued. So I like what I'm seeing here from a capital allocation perspective as well. Now let's look at our balance sheet. You do see that there's been some acquisitions because your goodwill's gone up. So your goodwill went from 1.6 billion to 2.8 billion. That extra 1.2 billion would be because they made some acquisitions along the time frame to kind of boost that goodwill. Anytime you buy another company for higher than their book value, you have to add goodwill to your book. That's just a little accounting metric. You see their PP&E has gone up, about triple during that time, about double. So 273 to 667. So they've doubled their PP&E, but they've not doubled their income. So you don't really like to see that, but PP&E is such a small point of their assets, it's not caused a doubling of their assets. They're carrying some cash, accounts receivable. They do have inventory here. Their inventory dwarfs their PP&E. It's almost triple. So it's really an inventory-based balance sheet plus goodwill. That's over half of your balance sheet between those line items. You see some long-term debt has doubled from $500 million to $1 billion. But again, long-term debt is only $1 billion versus a $10 billion enterprise value. It's really not a significant amount. I'm not worried at all about the amount of debt in this business. This is a low-leveraged business. Let's go to the cash flow statement. Net income, you see some depreciation here. That's a decent amount, 1 to 200 million. Do you have stock-based compensation? I don't like seeing stock-based compensation, but they're probably doing buybacks well in excess of that. And you see that here, the buybacks in any 1 year can be anywhere from 5 to 10, almost 5 to 10 times the stock-based compensation that year. And that's why despite having stock-based compensation, they're still retiring shares. I don't really know why you need stock-based compensation in a business like this. I would really love every company not to be doing stock-based compensation, but it is something that just happens. You can see some pretty steady acquisitions over the course of the decade. It looks like they're always buying something. Maybe they're buying new practices. This could be some part of their growth plan. So you need to understand how much of their growth is organic, how much is inorganic. That can play a little bit into the future returns you might get, because that's going to play, how much matters. The more organic it is, the more predictable that growth would be. The more inorganic it is, the more that price is paid is going to play into your overall return. So just something to be aware of. They're not paying a dividend. That is something I notice here. So it looks like they're putting all their excess cash and back into buybacks. I'm perfectly fine with that. I don't need a dividend. I'm well acceptable to companies that are just paying out buybacks. But I would really need to understand some of their growth plan before I would actually make a purchase in this stock. But I'm perfectly on board with, high quality companies putting all their cash flow into buybacks. So I think this company is interesting. It's probably worth going on my watch list. I'm not sure it's at the top of my watch list, but it's definitely a watch list stock because you have these 10% plus returns. Anything in the healthcare industry has a lot of attractive characteristics. It's a high quality business, 20 straight years of profits. You're hitting a 16% return on equity that gives you the possibility of these double digit returns that I'd like to see as a shareholder. And it looks like you're trading at a reasonable price. PE of 18 is not unreasonable. It's maybe on the higher end of fair value, but for the most part, very good opportunity in this company to get a double-digit return, so it'll hit my watch list. Thank you for listening, and until next time, stop paying fees, start building wealth. Like, subscribe. See you next time.